8.4%. That's the average yield of JEPI, DIVO, and PDI combined. SCHD pays 3.5%. That gap means retirees choosing SCHD are leaving $2,550 every single year on the table. That's real income gone. Most retirement advice still points to SCHD automatically, but the data tells a very different story, and that story starts right now. This is an opinion. 5 years of performance data pulled directly from ETF.com and Morningstar. 4 key metrics measured across every ETF featured here: yield, drawdown, expense ratio, and total return. That's the framework. No guesswork, no sponsored picks. Just what the numbers actually show when you stress test these funds against real market conditions. One of those metrics will completely change how you think about high yield. That's coming soon. Before we go further, a quick word. Nothing here is personalized financial advice. Every investor's situation is different. Tax treatment, risk tolerance, income needs, they all matter. This video is for educational purposes only. Always consult a qualified financial advisor before making investment decisions. Now, with that said, the data we're about to walk through is genuinely eye-opening. And the first number might surprise you more than you expect. JEPI yielded 8.1% in 2024. SCHD paid 3.5%. That's 2.3 times more income from the same dollars invested. PDI pushed even higher at 15.2%. DIVO sat at 4.5%. These aren't fringe funds, they're actively managed, battle-tested income machines. But yield alone doesn't tell the whole story, because where that income comes from changes everything. Put $50,000 into PDI, you collect $7,600 per year. That same $50,000 in SCHD, $1,750. The annual gap is $2,450 every single year. Over 20 years, that's serious money. But here's what nobody mentions about PDI's 15.2% yield. Roughly 25% of that payout isn't income at all. DIVO delivered 11.4% total return over 5 years. That's low double digits to seize. Not as flashy as VOO's longer-term numbers, but here's what matters for retirees. During the 2022 crash, DIVO fell significantly less than both SCHD and VOO. Smaller drawdowns mean less panic, less selling at the bottom, and more capital preserved when recovery comes. For retirees living off their portfolio, that difference is enormous. In 2022's brutal bear market, JEPI dropped just 13.7%. SCHD fell 19.2%, as SPY crashed 23.9%. The 5.5 percentage point difference between JEPI and SCHD sounds small. It isn't. On a $500,000 retirement portfolio, that's $27,000 more protected. Retirees who stayed calm during 2022 owe that partly to lower drawdowns. PDI carries a 4.46% expense ratio. Let that sink in. JEPI charges 0.35%. DIVO charges 0.56%. PDI costs 8 times more than JEPI annually. That fee doesn't disappear. It quietly drains your portfolio every single year. On a large retirement account, that number becomes shocking. And we've done the exact math on a $500,000 portfolio. $500,000 in PDI generates $76,000 annually. The same amount in SCHD generates $17,500. That's a $58,500 income gap per year. For retirees, that's the difference between thriving and struggling. But here's the uncomfortable part. Not all of PDI's income is real. About $5,700 of that annual payout is actually your own principal coming back to you. DIVO's expense ratio is 0.56%. PDI's is 4.46%. On $500,000, that means PDI costs $22,300 in fees every single year. The IVO costs just $2,800. That's nearly $20,000 more preserved annually with DIVO. Compounded over a 20-year retirement, that fee gap alone could cost you hundreds of thousands of dollars. JEPI's covered call strategy is brilliant for income, but it has a price. During bull markets, JEPI only captures 66% of S&P 500 gains. That means 34 cents of every bull market dollar is permanently surrendered. DIVO's selective approach retains 81%, XYLD and RYLD capture just 50 to 55%. High yield costs you upside. Whether that trade-off makes sense depends entirely on what you need your portfolio to do. Here's what most investors never check. Where does the dividend actually come from? JEPI pays from options premiums on equity-linked notes. DIVO pays qualified dividends from real company earnings. PDI pays leveraged bond coupons plus roughly 25% return of capital. That last one is critical. Return of capital is an income. It's your own money handed back. It erodes your cost basis over time. The tax treatment also differs dramatically. On a $50,000 PDI position, roughly $1,900 of your annual payout is your own principal returned to you. Not earned income, not dividends. Your money recycled. Over 20 years, that's $38,000 of principal quietly handed back, disguised as income. If you spend it without knowing this, you're slowly liquidating your own retirement. PDI's yield is real partially. Sharpe ratio measures return per unit of risk. DIVO scored 0.94. JEPI scored 0.90. XYLD scored just 0.64. RYLD scored 0.79. PDI scored 0.55. Higher yield doesn't mean better risk-adjusted returns. DIVO and JEPI prove you can collect strong income without taking on excessive risk to get it. That's the combination retirees actually need. A 2 to 4% annual return gap sounds small. It isn't. On a $50,000 starting portfolio over 20 years, a 2% lag costs you over $30,000 in lost wealth. A 4% lag? Over $60,000 gone. XYLD and RYLD have delivered that kind of persistent underperformance versus VOL. High yield with low total return is a slow wealth leak, $50,000 invested. Here's what each pays monthly. PDI, $633, RYLD, $479, JEPQ, $438, XYLD, $354, JEPI, $350, DIVO, the lowest yield of the group. The income differences are real. But now layer in fees, drawdowns, return of capital, and upside capture, and the rankings shift completely. 3 funds rise to the top. 3 ETFs are in the recommendation for retirees in 2026. JEPI, 8.4% yield, 0.35% expense ratio, only 13.7% max drawdown. DIVO, 4.5% yield. Highest Sharpe ratio at about double my 4 best risk-adjusted returns in the group. PDI, 15.2% yield, but 4.46% fees and 25% return of capital. Here's the uncomfortable truth. No single ETF gives you everything. High yield, high total return, and downside protection, you can only choose 2. XYLD, RYLD, and PDI chase yield and sacrifice total return, some by 3 to 4% annually. Over 20 years, that compounds into 60% less wealth. The right question isn't which ETF yields the most. It's which combination of income, protection, and growth actually funds your retirement for decades. Match the ETF to your need. Want maximum downside protection with strong income? JEPI. 8.4% yield, lowest drawdown at 13.7%. Want the best risk-adjusted returns? DIVO. Sharpe ratio of 0.94, qualified dividends. Want maximum income and can accept the fee and return of capital risk? PDI and a small allocation. Avoid XYLD and RYLD as core holdings. Their yields look good. The data is clear. In 2026, retirees don't have to settle for SCHD's 3.5% yield. JEPI, DIVO, and PDI offer real alternatives. If you understand what you're actually buying, yield matters. So do fees, drawdowns, and where the income comes from. Know all 4 before you invest. Subscribe right now if you want more breakdowns like this. New ETF and investing videos every week, straight to your feed.